So today I wanted to do an example of a property being analyzed by our new financial property investment calculator. It's on our website at www.montereypm.com calc.php. You can find it on our homepage of our website, which is www.montereypm.com. So we enter the calculator here, and I want to show this report as a tool for a realtor to show an investor an excellent investment property in the area. We're going to be analyzing the property at 371 Camino Aguajito in Monterey. It's in the neighborhood right near NPS. You can see you're close here to El Estero Park and also about 5 or 6 blocks from the ocean. It's a fantastic neighborhood. You have high-end renters, with Naval Postgraduate School being less than a quarter-mile away. You're close to downtown Monterey here. You can see Pearl Street leads into downtown Monterey and Alvarado Street. Just a fantastic area, high-end renters. We manage several buildings in this neighborhood and just absolutely love the neighborhood. So back to the calculator here. I go ahead and, if I'm a realtor presenting this to an investor, I want to put in presented by and your name. The reason for this, you'll see at the end of the demonstration. When you get at the end, you'll get a PDF printable report, and at the top the label will be presented by your name. So when you share it with your investors, they'll know it comes from you and they'll remember. You can put your contact information here as well, so that they know who to call. And that way you can send it to several investors. You can post it on Facebook for advertising. You do several different things to get the word out about this property. So I go ahead and I continue and I put in the property address in Monterey, California, and then I put in the annual property taxes. Now I calculated this myself. You can do it two different ways. You can take it off of the listing here. They have the tax amount at $8,349. Theirs is higher, so we're actually just going to go with theirs, $8,349. I like to do my numbers conservatively, and that way I'm planning for the worst case scenario and not necessarily always the best case scenario. So as I continue, I can add a photo. So if I wanted to add a photo here from this page, I could save to my desktop this photo, and go back to my calculator here, choose the file, and it would be, here's our photo. So that'll add it to our report so we can share that with our investors as well. Next step, so we proceed to enter the purchase price, after repair value, purchase closing costs, and estimated repair costs. Now I haven't seen this property personally yet. It just came on the market yesterday. I'm actually going to go take a look at it today. But it looks like it's a single family home with a duplex in the back, 3 units, so it's a triplex, total of 3 units. It says here in the description that it's well maintained. All the units have garages, which is fantastic for a multi-unit. So I can't estimate repairs just yet because I don't know how much is going to go into it. Closing costs, I put in at 4%. Typically speaking, for estimated purchase closing costs, you're safe to say in between 2 and 5%. So I went ahead and went with 4%. For my after repair value, like I said, I haven't been able to see the building myself yet. But based on the comps, it seems like it's priced pretty well. I know there's 2 other duplexes in this neighborhood. They're priced in the same price range. So $759 is priced to sell, in my opinion. I think this is going to be a good investment property for somebody. So after repair value, like I said, we'll leave it at $759 until we can find out more information, see the current condition, and find out if there's opportunities to lift the property value by putting a little sweat equity or improving the condition of the property. Estimated repair costs, like I said, we don't know this yet. To be conservative though, anytime you buy a property, it's going to need a little bit of work, so we'll go ahead and put $5,000. It says well maintained. Not sure what that means yet. Could need a little paint, could need new carpet. If it's well maintained though, chances are structurally it's pretty sound. Next on the calculator brings you into the loan details. So when you go and put in the loan details, if you're an all-cash buyer, this gives you the option to enter as a cash purchase. This will impact your results at the end. We're going to do this example as a non-cash purchaser though, and we're going to do it with a loan at 25%. 25% of our $759,000 comes up to $569,250. And then we're going to do a nice, safe interest rate of 5%. This is a rental property, and interest rates are still really strong, but just to be conservative, we're going to project our numbers at 5%. Points charged by lender and other charges from lender, we can enter these. It depends on what type of loan you're getting, on how many charges and fees you're going to get from your lender. For this example, I'm going to leave it blank just to avoid running the risk of overinflating fees. But keep in mind, typically with loans, there are some types of charges and fees. And you have the opportunity to either pay these loan fees out of pocket or wrap them into your loan. The calculator will calculate both decisions that you make. So if you're aware of what type of points your lender is going to be charging, definitely put them in here. And if you're going to be wrapping them into your loan, definitely select wrap loan fees. For this example, we're going to go ahead and leave loan fees and points out. We're not going to get an interest-only loan. We're going to have a typical loan paying principal and interest each month, and we're going to amortize this over 30 years. We could enter the typical cap rate for our area, which in my experience is around 4.2%, but this won't impact our numbers too much. It is something that you can leave blank because it's not too vital to the calculator. It's more for a guide for you to compare for your investors. So on to the next step. Here for the total grossly monthly rent. So what I did here was I wanted to add my units. So I went ahead and did a number, but I'll show you how I did it. If you already know how much just the total is going to be, you can enter it up top. But if you want to add units and do them individually, it's a great tool to do it. So each unit we're going to do individually. And for the single family home in front, the 2-bedroom, 1-bath, it says the total square feet here is about 2,000. So we're going to assume that each one is, maybe the house is 700 square feet and the two other ones are 650. So for the 2-bedroom, 1-bath with a garage in this neighborhood, I'm going to say conservatively rents for $1,900. That's a conservative number. I'd have to see the property. It depends on how big the square footage is of the home compared to the duplex. But based upon the comps that we have in this neighborhood, $1,900 is a very realistic rental rate. For the duplex 2-bedroom, 1-baths, these are also going to fetch fantastic rental rates. If you look here, I can see on the numbers what they're fetching currently, and I can tell you that these are dramatically under market rent. A 2-bedroom, 1-bath in this area should rent for no less than $15 to $1,600, even if it is dated, just based on location alone. So we are going to say that this unit is going to get $1,600, and this one's going to get $1,600. I think I did 17, actually 1,700. Because they come with garages. The garages alone you could rent for $200 to $300, just to somebody to have their opportunity to have a garage in this neighborhood close to downtown. It's really a huge benefit for renters, especially the Naval Coast graduate students. They love having a garage. Other monthly income, there's no paid laundry on site currently, so we're going to keep this at 0. Now on to the landlord paid expenses. We can see in the ad here that the tenant pays electric, gas, tenant pays water, tenant pays heating, tenant pays cable TV, tenant pays electric, and tenant pays garbage. So electric here is going to be 0. For our water and sewer, it's $870 annually, so for the month that's $72.50. Sewer is included in that, so that's just all one number. Tenant is paying garbage. We're not going to put an HOA fee in here. I'm not sure if there's an HOA fee for this neighborhood. Doesn't look like they have one listed. There may be something small, but it's going to be nominal. Monthly insurance they have listed at $1,200 annually, so we're just going to go ahead and move forward with their number at $100 per month. And then for other monthly expenses, we want to go ahead and add some extra expenses that they have listed here. So we can see that they pay, it says $100 in landscaping. I'm thinking that this is supposed to be a monthly number, not annual, so landscaping costs a lot more than $100 per year, and we can see in the pictures that there's a lot of green grass, so let's go ahead and say it's $100. Maintenance, they have it $675 annually. Now for maintenance, there's two different ways we can enter it. We can enter it monthly as an expense, which is what we're going to do for this example, or We get entered down here as a percentage of our monthly income. Now typically if they list something, I like to use it because it's based upon their experience with the building. It'll be always be relative to what type of condition the units are in. And so 675 worked out monthly is $56.25. And then I think they had a miscellaneous cost here. Yes, they do. Miscellaneous cost of $2,500. So that equals $208.33. So we'll just go ahead and put MIS 208.33. Okay. Now on to our monthly variable expenses. These are the expenses that are going to change every month and are going to be based upon income. Some months you'll have 0 of these expenses, and some months you might have 500. And so the safest way to calculate it is through a percentage. So beginning with vacancy rate, this is the amount of days per year that the units are vacant. Now, I think that 1% is a very conservative number for this building. Based upon 365 days in a year and 3 units, it's 1,095 days per year. If it were vacant 1%, that means it would be vacant a total of 11 days per year. My experience with these buildings is they rent very, very quickly, so I think 1% is conservative. If you are someone who likes to rent things slower and make sure you're getting longer term tenants or something like that, it could be higher, but just from the experience of our management team in this neighborhood, I think 1% is a conservative number even still. Repairs and maintenance, I went ahead and did as a monthly expense, as a fixed monthly expense, so we don't need to do it again here, but we could have done it as a percentage. Capital expenditures are things like the roof, the hot water heater, any structural damage, if a pipe bursts, any plumbing that we have to replace, utilities, things like that. So a safe number I usually say is to calculate 4%. Now most months this is going to be 0, but every 3 years you're going to get a big cost. Maybe you have to replace a sewer line and pay out $3,000 to $5,000 for that. So 4% is a very conservative, strong number to calculate when you're using these examples. Property management fees for a building like this is going to be in the range of 8%. You might be able to find a small discount around 7%. Some companies might charge you closer to 9%. For our company, we would charge probably 8% for this exact building. Future assumptions, like I said earlier, I love this neighborhood as a rental property. We're close to the ocean, and the neighborhood is just fantastic. I think the income increases per year have very strong implications, but for this example, we're going to be very conservative and just put them at the rate of inflation. You'll see in our results, it doesn't change the impact too much, and the reason for that is this calculator is to be based upon buying investment properties for cash flow. It's not going to be based upon buying for future appreciation. As a property management company, we focus solely on cash flow and see investing on appreciation as more of a gamble. So we're making sound investments based on cash flow. So after we enter all of our income and all of our expenses, we go ahead and calculate results. Now, as a realtor, this is a great page for you to share with your investors. You can see here, it's going to have your name on top along with the property address and the phone number that you entered before. So if you wanted to mass send this out to different investors that you have, it's going to be a great page to share with them. It's going to have your phone number, all the information. They're going to be able to make a quick phone call directly to you. So going through the results, it's going to list here our purchase price, our closing costs, all of our repairs, after repair value that we left the same because we don't know yet, how much down payment this property is going to require at 25% down, your total loan amount. We decided not to do any points or fees in this. We have a 5% interest rate, very conservative interest rate. That makes our monthly principal and interest payment of $3,050.86. So this is how much we would be paying in principal and interest to our lender each month. Our total cash needed to do this deal is $225,110. This is a combination of our down payment, our closing costs, and our repair costs. It also could be a combination of adding our points and fees if we're paying this out of pocket. Now on to our results. The monthly income that we found from the 3 units renting is a total gross monthly income of $5,300. I do honestly think this is a conservative number, and I think that you'll be able to get these type of rental rates very quickly in this neighborhood. Monthly expenses, after all said and done, are $4,613. This includes the capital expenditures and all the other variable expenses, along with the monthly fixed expenses of utilities, water, monthly principal and interest, and all the things you're going to see down here in the expense chart. Our monthly cash flow is going to be $686.89. This is a very strong monthly cash flow. It's going to fit most investors' needs of buying a property with the amount of cash flow that they need to have. It also gives you a safe buffer zone in case you do have those months where the large capital expenditures do come up. You're going to have a healthy monthly cash flow to pay for those expenditures. You see here, you get your pro forma cap rate and your purchase cap rate. In this example, since we had our after repair value the same as our purchase price, these are going to be the same. So pro forma cap rate is going to be based upon our after repair value, and our purchase cap rate is going to be based upon our purchase price. This is one of the most important metrics to look at when you're purchasing multifamily properties. Typically, it's used for 5+ units, a little bit bigger apartment complexes, but it's still very important when you're looking at smaller multifamilies. It's the net operating income divided by the purchase price, and it's an important metric, and it's an easy way to compare properties. My experience of sold properties in Monterey area, Monterey, Pacific Grove, Carmel, is they sell for much less than 5.92 purchase cap rate. They sell a little bit closer to 4%, and I see listing agents list properties usually in the high 3% range. So the fact that this realtor has listed it at this aggressive a price tells me he's pricing this to sell. He's ready. The sellers are ready to sell. The realtor understands what it takes, and William Smith did an excellent job of pricing this property. Net operating income, here we have $44,913, and then our cash on cash return on investment is going to be 3.66%. Now this number is going to be skewed based upon where you get your cash from. The total cash needed is $225,000. Now if your 25% down payment is coming from something like a 1031 exchange, or you're refining a property to get the cash out, of course your cash on cash return on investment is going to be higher because this isn't cash you had. Now this cash on cash return on investment is based upon if you were using the money from your checking account or from a different investment pool such as mutual fund or stock market. That's what this number is going to be based upon, because it's actual cash that you have, liquid cash. It's not based upon anything else that you might be selling or things like that. So moving down, we have our expenses chart. This is going to see our breakdown of what our expenses is. We see the by far biggest expense for us is going to be our monthly principal and interest. This is great news because once we have this property paid off, we know that 77% of our, or almost 78% of our expenses are going to be removed. And if you wanted to use some of that monthly cash flow to pay down that principal and interest faster and have debt-free income, would not be such a bad idea. Moving down, we have our financial info. So one metric that people really like to look at is the gross rent multiplier. Typically you want this number as close to 10 as possible. You see in other markets across the country such as St. Louis, Missouri, or other small towns where property values are closer to 50 to 100,000, you see gross rent multipliers of around 8 or 9. Typically the lower the better, but having a 10 times gross rent to purchase price is fantastic. So 5,300 gross rent to purchase price, 759,000. It's going to be 11.93 gross rent multiplier. This is still really strong, especially in California, and it's really strong considering that I think that the numbers for the monthly income are on the conservative side, and definitely will increase over time. You also get here your income expense ratio and debt coverage ratio, which are great numbers to share with your financial advisor and your accountant. This is going to be your ability to pay your bills and make your principal and interest. It also is going to give you your total initial equity. This number is heavily influenced by being able to impact our after repair value. So you'll have more equity in the beginning if you were able to improve that improve that number initially. Moving down, we see the analysis over time. Now this has to do with the percent increases over time that I mentioned earlier. We went at the rate of inflation, so 3%. If you saw higher rates of increasing coming over the next few years, this would more dramatically affect these numbers. But something that's nice to see here is you can look at year 30, and the year 30 has your numbers based upon when your mortgage is paid off. So you can see your operating expense, your mortgage payment stays the same over 30. So this is going to be at year 30, sorry, actually like that. So this is just your value over time, but you're going to see your property value increase, and you're going to see what that's going to be worth in 30 years, as long as it keeps up with the rate of inflation, which real estate usually does. Now, as a realtor, one of my favorite parts about this tool is at the very end, after you've run all the numbers and seen everything, you can play with the numbers and tweak it. You can edit the form and go back and change something if you'd like. But at the end, you get to create a PDF. The PDF is an exportable saved document that you can save, and it's going to run all these numbers for you. You can print it, you can attach it to an email, whatever you prefer, and you can share it with your investors that are looking for investment properties in the area. They'll go through all the numbers with them and allow them to make a quick decision on whether or not this property is something they would like to invest in. Recently, I shared one of these reports with an investor that I work with. Now, we don't do any sales at CNC Property Management, but we still do help investors find properties, and then we partner with realtors for them to go ahead and do the purchasing. But I shared this with one of my investors that I work with that we manage properties for, and he immediately said, "Get the realtor on the phone. I want to take a further look." So I think it took him about 2 to 3 minutes to look over this page, and he saw that the numbers worked for him. He liked the gross rent multiplier, he loved the cap rate, he loved the monthly cash flow. So this tool is just going to have dramatic increases to the effectiveness as you, as an expert in the real estate industry, and how you share your information with your investors. You can now speak to them as an investor with an investor mentality, and they can quickly make decisions without having to go and analyze the properties themselves. So once you get to this page, you go ahead and you can just save it to your desktop, or you can print it, and then you can create an email and send it out to your investors. So I hope this demonstration helps you better understand how to use this tool on our website and how it can dramatically impact your business and help you work with more investors. If you have any questions, feel free to call our office, 831-372-1964, or visit our website, www.montereypm.com.